Hello everyone, my name is Tze Kang, the expert tutor of financial management. This video will be discussing about the effect on financial performance of issuing debts or equity. In this part of the discussion, references will be made to the following source of information and references from the ACCA official resources. That's including Study Hub, particularly the contents that found in Chapter 8, 9, and 19. Secondly, referring to the technical article with the title Analyzing the Suitability of Financing Alternatives. Last but not least, ranges of exam questions are found on the practice platform, and guys, you are highly recommended to give a try and attempt the whole of the questions pertaining to the topic under the time constraints to ensure maximum learning outcome. The explanation and illustrations on how the financing positions or the financial performance of the businesses will get affected as the result of the issuing or raising additional finances of the businesses via debt or equity will be demonstrated on the following categories of area. First, I'll tell everyone why is there a reason for businesses on raising funds. With this understanding on knowing and finding out the reason of getting extra financing, how would these actions or moves be affecting the financial position and also performances of a businesses by going through a four-step approach that will be demonstrated and discussed in a while. Finally, how would these understanding be applied into a typical examinations questions in paper FM? Let's start with the reason for businesses in raising financing. Try imagine a business. Take for example, a listed company. It is common to expect from time to time ranges of sources of financing, in particular long-term financing, or in simple, it is termed capital, that will be raised for a series of investing activity, which denote from the following components. There are two main types of long-term financing that make available to businesses, particularly listed company, namely debt financing, such as taking up a bank loan, term loan, or issuing securities such as loan notes to the market in raising the debt financing from the public. Alternatively, by issuing share, most commonly in the context of the examination, examples like right issues or private placing will be among all the methods of share issue, the two of this common use method in raising equity financing. With these additional funding, fundamentally, most of the applications of this money will be used for the investment of ranges of non-current assets as well as working capital to support the ongoing business activity or to take on an additional project that made up by a series of specific assets as well as some amount of the investment in working capital. However, it is not always the case. Additional finances raised would definitely and all the time be flowed through to the investment of additional assets. Why do we say so? Let's explore two main reasons why businesses raise long-term financing. Reason one, that's denoted by RI or R1. It indicates the increases in one of these long-term financing, either debts or equity. But the purpose of these additional fundings raised will be mainly used to pay off or to return back to the original group of investors. Such change in a mixture or the composition of long-term financing is generally termed as a capital restructuring exercise. A very common examples under R1 would be of raising additional equity financing via right issue or private placing in order to pay off loan notes or bonds that is falling due. That is one of the typical examples under R1. Alternatively, here comes the second reason. Let's denote by R2, whereby additional funding was raised, again, either by taking up additional bank loan or the issue of loan notes as well as issue of share. One of this will be used as mentioned and specified by the exam questions. And again, what's the purpose of that extra funding that you use for? Instead of taking this additional funding to pay off some of the existing debt financing, this money will flow onto acquiring ranges of additional assets, such as taking on a new investment on the project by building a plant, a factory, by installing additional machine. That's accompanied by additional investment in working capital as well. With additional asset, what does it mean? It will have an increase in the capacity of businesses in operating at the larger scales. And it's obviously a processes that denote an expansion of businesses. In other words, the growth of the business. These are therefore the two common reasons that's seen in the examinations, telling the students what exactly the money will be used for from raising additional debts or equity financing. So, once the reason of raising the funds were identified from the storylines given by the questions, how are we to carry on the assessment to study, to quantify the effect or impact on the financial performances as well as the financial positions of a particular business? That is the kind of the questions that will bother many students due to the nature of an unstructured types of calculations will be expected. Guys, in this part of the video, I would like to introduce you a more systematic approach. Namely, I call this as four-step approach in dealing with quantifying such impact. First and foremost, try to imagine, again from the background of a listed company as mentioned a while ago, this company would have carried out businesses in the past. That is where represented by the left-hand side of this diagram. Supposing that is where the businesses is located now. And obviously, years to come, let's denote by year end. There's a plans upcoming in the company. First and foremost, whatever that took place in the past, these were presented by the historical financial performances that reflected clearly in ranges of recent financial statement that's mainly made up of the statement of profit or loss, let's call SPL, as well as the statement of financial position, let's call SFP, which both of these statements are usually provided by the examinations questions. That the questions will go on to highlight to the students that is a plan for the firm to issue either debt or equity. In a rare occasion, sometimes there will be a combination of issuing of debt as well as equity. These activity, these planned action would definitely come alongside with the intentions that will be stated clearly by the questions. Again, it will be telling either the additional funding that raised will be catered as part of the capital restructuring exercise that denote by RI or R1 as we mentioned earlier, and alternatively, it could also be indicated as R2, where it is catered for expanding or supporting the growth of the business's activity in the future period. With such intention that to be used on the additional finances raised, the first step that you would need to start figuring out in order to carry on the assessments on the impact is try to formulate and try to estimate what would be the forecast financial position or financial performances in the coming year after the issue of debt or equity for either R1 or R2 reason. This part of the job require fundamental accounting knowledge that you would have learned in financial reporting subjects. And what you have to do is just to make use of two sources of information, namely the recent financial statements information together with additional information regarding amount to be raised from debt or equity and the details regarding either R1 or R2. Try to incorporate both of these information as a basis to form and to construct the forecast financial statement, which again made up by statement of profit or loss. Guys, the statement of profit or loss in the exam questions were mainly offering an extract of information, normally starting with profit before interest and tax, PBIT in short. Alternatively, it is called operating profit, followed by the amount of the financing cost, to be more precise, the interest expense. And not to mention, the rest of the component in the SPL would then come alongside with tax as well as the final figure, the profit after tax, PAT. Other than the profit and loss, the statement of financial position, which mainly comprise of, as we have mentioned a while ago, the sources of financing, as well as the list of the asset invested made up by non-current asset as well as working capital, as long as it is financed by the long-term fund. You are therefore required to determine the amount of the forecasted value for component in the P&L, such as PBIT and interest expenses, in order to determine the forecasted tax as well as the forecasted profit after tax. Similarly applied for the statement of financial position, SFP. Based upon the additional information, students are required to determine the forecasted amount of debt and equity after the financing activity, and also the amount of the increase in the non-current asset as well as the working capital, if it is catered for expansion of businesses from the additional fund raised. A casual reminder to all of you guys, whenever you attempted to derive the forecasted value of the component that's shown in the statement of financial position, do bear in mind the following relationships, whereby the amount that's shown in every items under the statement of financial positions are largely derived based upon the opening balance, which is largely referring to the balances that's shown in the recent periods of the statement of financial position. Then you will have to just adjust according to the changes as relevant to the specific item to derive the closing balance that will be representing the amount to be shown in the forecasted statement of financial position. As a casual reminder to all, as to which type of changes would affect which item in the statement of profit or loss as well as the statement of financial position, let's take a look at the following guidance for references. Supposing if the changes is classified as R1, whereby it is capital restructuring, very likely the impact on statement of profit or loss will mainly be on financing cost component, where the amount of PBIT are likely to remain unaffected. Should the additional fund is through the issue of debt, very likely they will expect an increase in the interest expenses. However, if this capital restructuring is involving in repayment of debts from the additional fund raised in issuing share capital, on the reverse side, the interest expenses would have decreased as such. So guys, you were supposed to know how to make the relevant adjustments to derive the forecast or the revised interest expenses after the financing activity. And as such, as long as at least one of these items got affected by the change, be prepared the amount of tax and therefore the profit after tax will also be affected accordingly, and you just got to walk through the whole calculation to derive the forecasted statement of profit and loss accordingly. How would these R1s be affecting the result of the statement of financial position? Again, as long as there's a change in the long-term financing, whether there's an increase or decrease in capital or equity, you will just have to make the relevant adjustment accordingly. And it is worth to take note under R1 category, because it does not cause any changes, particularly increases in new asset acquired. The value of the non-current asset as well as working capital is likely to remain unchanged. That is therefore the summary of how do you make up the forecast financial statement based upon R1. Let's take a look at R2, whereby it denotes the expansion of the businesses, which we have mentioned earlier. With these kind of changes, first and foremost, it is likely that the profit before interest and tax, the operating profit, would have gone up due to the enhanced capacity of earnings ability. The company would expect to generate more profits according to the statements given by the questions. As to whether any impact shown on financing costs, it depends what types of additional funding is being raised. The interest or the financing costs would expect to increase if the additional finance is from debt financing. Alternatively, if additional finance is raised through right issue or private placing, there will not be any changes on financing costs. Same thing applies. As long as one of these items got affected, be prepared to adjust the taxation and the profit after tax accordingly. With R2, how would these affect the statement of financial position? Very likely, similar impact will be applied onto financing, except when we raise additional funding, either from debt or equity, it only has an effect of increasing the item that is being relevant. There is no reduction on other types of financing because the additional fund raised would have invested to acquire additional assets. As such, it will show an increase in the assets on the other end of the statement of financial position. Guys, regardless of R1 or R2, as far as the statement of financial position is concerned, you can still see the double entry principles, the equations that holds back the equations of the statement of financial position is always there and it always prevails. That is one of the mechanisms to ensure a quick checking as to whether you have managed to got a correct forecast financial statement. Guys, these would therefore illustrate as the first steps in dealing with the assessments of such impact to provide and to prepare the forecast financial statement. What will then be coming up next? It's second steps. How are we to assess the impact? And obviously, that require ranges of financial ratios that, again, it is not something that is new to you. Ranges of relevant financial KPIs that assessing the changes on profit before interest and tax will commonly be looking at growth rates or changes in operating profits, Alternatively, by examining the changes in the return on capital employed, where it is based upon the PBIT as the numerators in the ratio. As for the assessments on the impacts shown on the financing cost, guys, I suppose interest cover is not a new indicator to you that could be used to assess the change on the interest cover as a result of the change in the financing cost. These will lead to the third and the final assessments on the impact shown in the statement of profit or loss, particularly looking at the profit after tax. And what are the relevant KPI that will be used based upon the PAT? And the answer is earnings per share, whereby these are therefore the ranges of key financial ratios that you may consider to use it to measure what would this ratio be based upon the recent financial statement as a start, and then recalculate the forecast financial ratio according to the forecast financial statement. You will therefore have two sets of these ratios that show a difference in value. That will form the basis of your commentary in a while. Similarly apply to assess the impact shown on the statement of financial position. As far as the change that's shown on the sources of long-term finance is concerned, here will be the most common used financial ratios. The financial gearing, or we term as capital gearing. As far as the changes that shown on the investment in the asset is concerned, the relevant financial ratios would therefore be asset turnover. All of these KPIs will be the most common used instrument that serve as the evidence to study the changes before and after the incidents. The calculations of all these financial ratios will therefore be the second steps in this approach shown. Once all the statistics and the evidences were derived, these numbers will therefore serve as an evidences from both the KPI that found based upon statement of profit or loss, as well as the KPI that derived from the statement of financial position, will be served as the basis to form the step 3 of the job, that is to comment or to analyze the changes, highlighting what has changed. And finally, if the questions is asking the students to give a recommendation as to which type of the sources of fund is preferred, you will therefore go for the final step, which is step 4, that derive your recommendation with a clearly justified reasons of your suggestion. Guys, these are the forming steps that I would like to share with you in assessing the impact of the above mentioned change. Guys, it is time now to show you the way that we formulate an answer plan based upon one of the following examinations questions under section C of the FN exam. Please take note, this video is not meant to produce the full scale of answer, but it is to show the application, the relevance of the discussions that we made earlier that helps to better understand and to structure your answer planning to respond to one of this requirement, A, that is asking the candidates to evaluate whether, based upon purely financial ground, should the company finance the expansion of the business. Remember, that is clearly R2 of the reason. Should this expansion be financed by either debt or equity? That is a typical question that students would always get worried. But again, this worry will end here as long as you are able to apply the 4-step approach as shown below. You should spend a couple of minutes to try understand the full range of information given on the left-hand side of the screen before listening to the following diagnostic for you. By now, you should have got an understanding on your own answer planning. Let's take a look at what I will suggest you to do. First and foremost, knowing that this is the amount of funding that the company called Spy Company would like to raise to support the expansion of the ongoing businesses. With this expansion plan, as discussed earlier, it will cost an increase in the profit before interest and tax, in this case is by 20%. And other than that, the following information are the recent financial results of the company, which is clearly shown in the following table. Guys, can you tell where is it coming from? And the answer is the statement of profit or loss, obviously. So based upon the existing and the recent financial results, we would like to examine by looking at the amount of funding we want to raise up to $15 million, either based upon issue of debt, namely through the issue of loan notes, where the loan note structure is mentioned and given. As an alternative channel, by issuing equity financing via right issues would be the second alternatives. Lastly, some information from the statement of financial position, such as number of shares, and also some general information on tax rate is given. Spend some time, think about how to organize this information, fit into the 4-step approach that I have discussed earlier to show you in order to assess purely on financial ground, what you have to do. First step, copy the entire of this template into the Excel and starting with the figure before the change, which is exactly shown by this column. Then you will have to come up with the next column after the change, where additional financing has been raised, with all the adjustment as discussed earlier, based upon the components shown in the P&L extract, as well as the number of shares that's shown in the extract of the statement of financial position. Based upon these two sets of the financial statement information, you will then be able to come up with some key performance indicator as discussed earlier. You would then work out two sets of key financial ratios. From this ratio, that will become your basis of commentary to pick up and highlight to the marker what exactly has caused the change and what is the implication on the change. And finally, from your comment, that will become your basis to make up your recommendation to answer these questions. Guys, I hope by listening to the answering plan, that gave you a better appreciation with the 4-step approach as discussed in this video. Until then, take care.